In this part, we're going to discuss the efficient market hypothesis theory developed by Farmer. This is a crucial theory that will come up time and again when we discuss equities, share price reactions, and equity valuations. This theory is one of the most well known. We use it and we assume it to be true for various assumptions in our mathematical models for the valuation of equities. And depending on which degree you're doing, we will certainly revisit this theory in your final year, whether that's through the investment management module for finance investment, or if that is the financial responsibility module for business with financial management students. So this is a crucial theory. It's very well debated in literature, and there's very good arguments for and against this in practice. But in this part, I'll explain what it is and the implications if it's true or if it's not. And then I'll leave up to you guys to decide whether you believe in this theory and then read in the research for and against. And I'll give examples for both. But whenever we talk about efficiency when it comes to the markets, there is a range of different efficiencies we actually could refer to. So operational efficiency to start with is all about the fact that the process of buying and selling equities and so on is low cost, it's effective, and that everybody has access. Allocation efficiency goes back to the concept of getting resources to people that have it, to people that don't, and allocating resources efficiently for obviously generating wealth or for firms to make them more profitable. There's information efficiency to ensure that everyone has the access to the right information at the right time and at the lowest cost. And this is where in the stock market, any sort of announcement by a firm should be made to the stock exchange first for them to disseminate it via the major news outlets. And the last one is pricing efficiency. And this is the concept that really links to stock market efficient hypothesis. And this is about the fact that share prices should reflect all available information. So market efficiency, or EMH for short, is mainly concerned with pricing efficiency. And efficient market hypothesis was developed by Farmer. Eugene, at the time, was a member of the University of Chicago booth, and his work with Hans and Schiller, the empirical analysis of asset pricing, did help them achieve a Nobel Prize for the work regarding this theory. So this theory has been around for a while, but it's obviously had major implications on finance and the pricing of assets, and then in 2013 they did receive a Nobel Prize for this work and this concept. So what does the theory suggest? Well, it's proposed that there's 3 types of pricing efficiency. The first one is weak form, which suggests asset prices only reflect past information. So this could be previous annual report data, previous dividends, any sort of historical information. There's semi-strong form, and this is where any asset incorporates past information as well as the present news and present market information. And then the last one is strong form. Well, this says the price includes past, present, as well as privileged information. So the share price will reflect insider knowledge. So if you think from practical terms, investors, they want weak form, because weak form doesn't reflect current information or current news, therefore you could gain some advantage from investing now for when the share price does incorporate the news, and therefore you can take advantage of the new price change. Regulators, and I suppose the market as a whole, would want semi-strong form, therefore the pricing is efficient, it includes past and present, therefore there shouldn't be scope for gaining an advantage. So regulators certainly aim for a semi-strong market. And the last one, strong form, this is what regulators have put rules in place to avoid. So as we discussed in Lecture 6, insider trading is illegal and there's rules surrounding insider trading. And this is so that no one takes advantage of privileged information. So when the market is informed of it, for semi-strong, then no person can take advantage of share price movements. So investors want weak form, regulators want semi-strong form, and regulations are in place to avoid strong form. So if you're ever asked, is the market efficient? Ideally, we're looking for a semi-strong form of efficiency. If you want to put it into a diagram, this example could be anything, but in this case, I've just got BMW share price. And if the market is semi-strong form, then the price should be correct efficiently. And therefore, whenever the announcement is at day 0, the share price should correct in a straight line to whatever the new price should be. But we do have a few other lines here that suggest when the market is not as efficient at pricing as it should be. So you have line 1, which demonstrates a slow reaction where the market is quite inefficient, it's actually working out what the price should be following the news. Line 2 is potentially insider information or some sort of leakage, again quite inefficient because the share price has already moved prior to the event and therefore some advantage could be taken of. And then you have line 3, which is an overreaction, quite common in practice. The market doesn't really know how to react to the news, so there's an overreaction and then a price correction, again quite inefficient. And finally, number 4 would demonstrate a persistent inefficiency, where the market can't actually correct the price accordingly, and the share price didn't actually get to where it should be. And again, this is where advantage could be taken of if someone was to potentially buy it knowing the share price should be up to the black line. And if it does eventually get there, this person would benefit. Let's have a look at the number of implications for this theory. So the first lot is if stock market efficiency is true and the markets are semi-strong form efficient. These are the implications if it's true. If true, it's impossible to beat the market. Because the market incorporates all previous information and up-to-date news, therefore individuals cannot beat the market. The market should price accordingly, therefore firms can't take advantage of this. You may as well just invest in the stock index and save your time trying to outbeat the market if the market pricing is efficient. And this is because the capital markets are rational and reflect all available information. And if there is new information, then the share price should move and move accordingly in a swift manner. But this does assume that the market is rational. So this is one of the major arguments to why this theory is incorrect, because irrationality and irrational behavior does exist from investors as humans. Also, if the market is efficient, then if there was an incident where the share price didn't move accordingly and didn't correct efficiently, then the market would actually spot this. And then if you were quick, you could make a quick gain, and the likes of an arbitrager who spots price differences, they would take advantage of this, exploit the profitable opportunity, which is also classed as a bit of luck, because it wouldn't happen all the time and it wouldn't be the same people doing it. But therefore, if there was any price discrepancy, the market would see it, solve it and sort it. And therefore, the likelihood of everybody gaining or beating the market is not possible. Only a few might do it by luck. Also, another implication of this is that the news or a news item is mutually exclusive to the previous news item. Thus, the share prices move in a random walk, which is a concept created by Kendall in 1953. Therefore, if they're efficient, share prices should follow random walk when new information becomes available, and therefore you should not be able to spot any patterns. Therefore, any sort of technical analysis is actually pointless if the stock market is efficient. In this example here, there is an observable pattern. But if the market is efficient, then if a pattern is observed, then over time, investors or the market will realize there's a pattern, therefore this pattern will disappear. And this concept of a pattern disappearing supports the concept of random walk. If everyone can see a pattern, then everyone will react to this and then do something different, therefore a pattern would eventually disappear. For instance, in this graph, if you've seen a pattern and you thought, well, actually, the share price following the pattern should go up, therefore everybody would see the share price is going to go up, they'd all invest, therefore the price would go up, but much quicker than the previous pattern. And then if the share price went up much quicker than the previous pattern, they might go home and sell out and take a gain. But this quick share price moving upwards, then potentially back downwards, would be in contrast to the previous pattern, which was more gradual. Therefore, if patterns are spot, then the market would react differently anyway, and then the pattern would disappear over time. There is a large body of literature, empirical evidence and analysts that actually support this concept that the stock market pricing is efficient. And researchers found that likes of investment analysts and mutual funds do not constantly beat the market. So under Farmer, you can get lucky, you can have this arbitrage and opportunity, but it's not the same people doing it all over. Therefore, the stock market is efficient. Empirical evidence suggests that the majority of the Western world in an efficient stock market, prices do promptly reflect public information on announcement. There's lots of research into technical analysis studies to see do they actually outperform the market, and there's a lot of evidence to suggest technical analysis doesn't, and therefore the use of patterns doesn't actually help you outperform any market or make additional gains. And there is some evidence that stock prices do actually follow random walk. But as you can imagine, with all of these kind of studies, it really depends on the market, on the sample, and the methodology. So what are the implications if the stock market is classed as inefficient and this theory does not uphold? Well, this means it is possible to beat the market. You can put strategies in place and you can constantly beat the market, and there is a reason to do lots of research and lots of rebalancing to outperform the market. And this suggests it's worth not just investing in a tracker or an index. You may as well invest in individual stocks to try and outperform the market as a whole. And it says that a good stock picker would be able to beat the market, and higher returns could be possible if the markets are inefficient. Also, if the markets are inefficient, then random walk should not exist. There should be observable patterns, and there are a number of observable patterns out there that's been identified, mainly seasonal effects. So there's something called the January effect, which is all about taxation in the US and when tax receipts are paid and how that impacts the value of a firm. Historically, this is related to small and medium-sized listed firms in the US. There's patterns about days of the week, so the Monday effect and the Friday effect and investors' behavior. And there's also concepts of sell in May and go away, which is also known as the Halloween indicator, as well as seasonal effects. There is small firm effects, and there is lots of empirical research to suggest that the likes of small firms do tend to have abnormal returns when it comes to their equities due to their kind of stage of growth. As well as the January effect, there is other various calendar effects. Dependent on the tax year, then some investors may sell out to crystallize gains, or if they're holding a loss, they might do that to benefit from additional tax brackets next year if they bring a loss forward, for instance. And this sort of activity certainly is observable on a large scale and could be seen to generate a pattern when it comes to investor behavior, buying and selling shares, which reflects in the price. And from a corporation point of view, income tax in pensions and investments also potentially determine how share prices perform. If everyone's selling due to tax, then supply and demand, you'd observe the share prices dropping at certain months due to tax reasons on that point as well. So there's plenty of observable examples there. Additionally, there's lots of examples of market overreactions, if that be negative or positive. Majority of the overreactions are on the negative side. When there's bad news, share prices tend to drop a lot further than what they should, and then they do bounce back to the level they should be at. And because there's an overreaction, this can be predicted, and therefore it violates stock market efficiency, as you could potentially buy and sell knowing that an overreaction would occur and take advantage of this overreaction, depending on which strategy you use. Additionally, there's evidence out there that shows there's a lot of excess volatility, specifically during times of stress. Thus, this excess volatility gains can be made by individuals, and you can outperform the market based on volume trading. Again, this kind of goes against stock market efficiency. There's evidence out there that new information is not always incorporated in the price. And because individuals don't get the information at the exact same time, for instance, Bloomberg gets it 7-8 seconds faster than everyone else, but Bloomberg's a lot more expensive than the likes of Thomson Reuters, for instance. So not everyone has access to the information simultaneously, and irrational behaviour can take over. Therefore, these are examples where stock market efficiency can't exist, and they refute the theory there. And there is also examples of mean reversion, where this is the concept where potential stocks are performing quite poorly. Therefore, there's a belief that if they perform poorly now, in the future they'll perform better and get back to some sort of mean level. And this sort of negative and positive irrational behaviour is an observable pattern. Again, a pattern that can be taken advantage of. Therefore, prices don't move random walk. Therefore, you can take advantage of this. Therefore, there is a number of practical issues. So let's just have a look at a few here that you may have seen. So when you get investment advisor reports, are they useful? If the stock market is efficient, then no. The share price already takes into account the investment analyst report because it's publicly available. Are tips useful if the stock market is efficient? Again, no. This tip is given based on all available information, therefore the market already knows that, so you can't make any additional gain from getting this tip. So the market being efficient means tips are useless. And the last one, do prices always rise on good news? Well, if the stock market's efficient, the good bit's quite irrelevant, because the stock price will respond to the announcement of the information, whether it's good, bad, or unexpected. And that doesn't necessarily mean that they always rise if it's good. The good bit is quite irrelevant if stock market efficiency is to be believed. However, if you believe that stock market is inefficient, then an investment report could be useful. It could potentially give you an example of an opportunity, and you could potentially make abnormal returns if you are the sole person to read these reports. Again, if the stock market efficiency is not to be believed, then tips could also give you a chance to exploit potential returns. And then for the last one, about the good news, does that mean the price will go up? Well, not necessarily. Because it's good news, the stock market reaction may overshoot mean reversion, and then the price could get back to some sort of equilibrium. But again, an overreaction would allow for excess gains to be achieved. Now, we've gone through the implications if it is efficient, if it's not efficient. We've gone through the evidence that supports it and that doesn't. From a personal point of view, I don't believe in stock market efficiency. I do believe it is possible to outperform the market. Farmer says investment analysts can outperform the market by luck, so you can get lucky, but it also suggests that it's not the same person that's lucky. So you might get lucky one year, that another firm might get lucky the next year. But there's a lot of evidence out there to say there is firms that constantly outperform the market. You probably might be very familiar with the likes of Warren Buffett's organisation and the company he works for, and the fact that quite a lot of people follow his advice, which also distorts the market in itself. But even over this last year, we've had an interesting market in 2020. There was a large correction in their share price, and since then share price has been going up, and the fundamentals haven't really changed. In March, share price dropped 40%, but underlying characteristics hadn't changed. The only thing that had changed was potential expectation of future incomes and future revenues. But if you think back in the UK lockdown, you had firm share prices like retail going up and up from the crash, but yet the shops were shut. How can that mean the stock market's efficient? I'll let you do your own research, your own reading, to come up to your own conclusion.